Hello, welcome to this advanced reading on derivatives, reading 57, Basics of Derivative Pricing and Valuation. Reading 56 is a prerequisite for this reading, and if you have not done reading 56, I suggest you go back, watch the video, understand and imbibe the concepts properly, and then come back here again. Also, in the introductory content that we have uploaded is a lot, because it would be easier to understand this concept after the introductory material you've gone through. There we've used animation, figures, examples, and there are places where I've gone into a lot more detail than the curriculum. You know that I am strictly for LOS, but still I feel that introduction, those animations were necessary for a solid understanding of derivatives going ahead in level 2 and level 3 especially. Earlier in derivatives there used to be around 6-7 readings. One reading for options, one reading for futures, one reading for forwards, one reading for swaps, one reading for risk management application of derivative strategies, and so on and so forth. But last year in fact, the institute has consolidated all that into this one reading, which I feel fails to deliver the message in a way it should have. We'll go LOS by LOS, but I'll try to go deeper into the concepts of derivatives in order to build sound fundamentals you all should have. LOS A, explain how the concepts of arbitrage, replication, and risk neutrality are used in pricing derivatives. Distinguish between value and price of forward and futures contract. Again, please make sure that you're familiar with all the basic concepts regarding derivatives that were covered in the previous reading, derivative markets and instruments, before moving into this reading. Equities, fixed income, securities, currencies, commodities are all assets. An interest rate is not an asset, but it can still be structured as the underlying of a derivative. As mentioned in the previous reading, please treat derivative as a betting tool, as a betting instrument, although the formal definition means that a derivative is a financial instrument that derives its value from the performance of an underlying asset. The different types of derivatives, as I had told you, were equity derivative, fixed income securities, currency derivatives, commodities. These are the broad categories of derivatives. Moving on to pricing the underlying asset. The price or value of a financial asset is determined as the present value of expected future cash flows plus any benefits and subtracting any cost of holding the asset. All this is discounted at the appropriate rate of return, appropriate discount rate. Whenever an investor makes a trading or an investment decision, he compares the fundamental value of the asset, the intrinsic value, the should-be price, to the current market price, and then decides the profit potential after subtracting all transaction and trading costs in light of the level of confidence he or she has in the valuation model. The price, or I'd say the fundamental value of an asset that incurs cost theta and generates benefits y, is calculated as the investor's best prediction of the spot price in the future is denoted by E S subscript T. The required rate of return, also known as the expected rate of return, is the return that is used to discount the expected future price of the asset. which is denoted by K. At the minimum, this rate includes the risk-free rate denoted by RF. For risky asset, it includes a risk premium denoted by alpha. On a general note, investors are risk averse and they require premium for bearing risk. Ceteris paribus, an investment with a higher risk premium will have a lower price because of discounting. For example, stocks that are declined in value over a particular period did not earn risk premia, even though someone obviously bought them with the expectation that they would. The point is that risk premium must exist in the long run to entice risk-averse investors to accept and take risk. There are many assets that generate or incur monetary and non-monetary costs and benefits. Example, maybe equity offering dividend, bonds offering coupons, investments in foreign currency generate foreign risk-free rate of return. Commodities may offer convenience yield. However, commodities may also have some storage cost. We use the symbol theta to denote the present value of costs and gamma to denote present value of any benefits associated with holding the asset. The net of these costs and benefit is often referred to as carry or maybe cost of carry. Different interpretations, but our author has mentioned, the author under consideration has mentioned both the terms. We shall assume the costs and benefit from the underlying assets are known with certainty, so they are discounted at the risk-free rate to obtain the present values. To summarize, the price of the underlying asset depends on expectations, risks, and the costs and benefit associated with holding it. In the later sections, we move into pricing of derivative instrument, which establishes a link between the derivative and the spot market. This linkage is via arbitrage. Do note that we have already introduced arbitrage, the law of one price, and market efficiency in reading 56. As alluded to it earlier, if you're not comfortable with it, please go through the concepts before moving ahead. Given assets X and Y produce the same values at time T, and logically speaking, they both should be priced at the same price. However, if asset X is selling for less than asset Y, there exists an arbitrage position as shown in the diagram. The main fundamental funda of any investing is buy cheap and sell dear. Whenever arbitrage opportunities rise, traders jump up and look to exploit them. And this happens very quickly and swiftly. The increased demand for the underpriced asset results in an increase in price, the basic law of demand, and the increased supply of the overpriced asset results in the decline in its price, the basic law of supply. This keeps on happening until the price of both the assets, in our example X and Y, converge. On a practical note, prices may not converge precisely or as quickly as we might think, because the costs of trading may exceed the benefit. For example, the price of X may be $5.8 and the price of Y might be $5.88. Do you think arbitrage will still exist? Arbitragers will still continue to engage in arbitrage? Maybe not. If the transaction cost is greater than $0.8, it makes no sense. If the transaction cost is $0.1, it makes no sense. And therefore, perfect convergence of price may not happen. Since the value of derivative is directly related to the value of an underlying, derivative actually derives its value from the underlying, the derivative can be used to hedge a position on the underlying. When the underlying is combined with the derivative to create a perfect hedged portfolio, all the price risk is eliminated and the position earns a risk-free rate. If the hedged portfolio, I would rather advise you to write these points which I am saying now. Number one, If the hedged portfolio generates a return excess of the risk-free rate, arbitrageurs will borrow at the risk-free rate and go long on the hedged portfolio to earn riskless profit. However, if the hedged portfolio earns less than RF, arbitrageurs will short the hedged portfolio and invest the proceeds at risk-free rate. Any mispricing will be exploited until the prices are pushed such that the both risk-free transactions earn the risk-free rate, neither less nor more. Please look at this diagram to understand the concepts we've discussed. Most derivative pricing models are established on the assumption that no arbitrage opportunities can exist. The price of the derivative is the unique price that precludes arbitrage opportunities. Further, these concepts will get clearer when we go into the topic of pricing of forward contracts later in this reading in LOS D and E. Replication, as the name suggests, refers to creating an asset or a portfolio of asset from another asset, starting with what we have just explained regarding the assumption employed in the pricing of derivative. Asset plus derivative is equal to a hedge portfolio, which is equals to risk-free asset. We can come up with the following replication strategies. Now I'll illustrate the application of these replication strategies in the section of on forwards. There I will also show you how positions on swaps can be replicated using forward contracts and assets later in the section on swaps. Asset plus derivative equals to risk-free asset, and after that, with the help of basic algebra, we can derive the other two. Risk aversion, risk neutrality, and arbitrage-free pricing. When it comes to pricing derivatives, we do not discount the expected payoff of the security at the rate that includes a risk premium. The fact that a derivative can be combined with an asset to produce a risk-free position can be used to infer its price. We'll soon see the same. This means that investors' risk aversion is not a factor in determining the derivative price. So, in pricing derivatives, we can assume that all investors are risk neutral. Derivative pricing models discount the expected payoff of the derivative at the risk-free rate other than the risk-free plus risk premium rate. Also, when we go through binomial option pricing, we will see that the expected payoff is calculated based on something known as risk neutral probabilities and not true probabilities. However, let's assume that as of now that investors are risk averse and that derivative pricing is sometimes known as risk neutral pricing. Sorry, I'd take my words back. Investors are risk neutral and derivative pricing is sometimes called risk neutral pricing. There are certain limitations to arbitrage. In the earlier reading, we mentioned significant transaction costs are one of the reasons that arbitrage opportunities remain unexploited. Other reasons include the transaction may require a large amount of capital which the arbitrager doesn't have access to, capital to maintain the position as well, shorting assets that are difficult to short, and in many countries shorting of assets is not allowed. And finally, the transaction may entail significant risk, especially if the relevant derivative pricing models are based on complex whose parameters are subject to model specification risk. Pricing versus valuation. Let's start with the equity or maybe the bond market. The price of a stock or a bond refers to its current market price, while the value of the stock or bond refers to the intrinsic or the fundamental value of the instrument, which is generally estimated through valuation models such as discounted cash flow, residual income models, PE multiples, EV by EBITDA multiples, and so on and so forth. However, when it comes to derivative markets, the notion that value represents fundamental value remains valid, but the interpretation of price is totally different. Price, as it relates to forwards, futures, swaps, refers to the fixed price agreed upon at contract initiation at which the underlying transaction takes place. These securities do not require an initial cash outlay at initiation, and hence there is no concept of price being paid at the beginning. The price is zero at beginning. On the other hand, value of these contract fluctuates in response to change in the price of underlying. There are, I'm sure there are a couple of you who are not able to understand and digest everything, and please accept my apology for this, for the same. But I assure you that as we go forward and as we do some numericals, these things will get clearer and clearer. LOSC, LOSD, and LOSE. Coming to a basic thematic discussion, a forward contract is a contract between two parties where one, the F plus or the long forward, has the obligation to buy, and the other, F minus or the short position, has an obligation to sell the underlying asset at a fixed forward price which has been established at the at contract initiation, but this exchange will take place at a future date. The long position will benefit when the price of underlying increases, and the short will benefit if the price of the underlying falls. Let's work with an example. Suppose that Jane enters a forward contract with Michael to buy a share of GGLE stock after 30 days for $600. This is the forward price. This is the price determined at inception and the price at which the transactions at the end of 6 months will take at the end of 30 days will take place. Jane is F plus while Michael is F minus. Neither of them pay any money to enter into this contract. There are two ways to settle this contract at expiration. We will illustrate the two settlement method assuming that GGLE stock is valued at 800 at the settlement date, that is at T30 after 30 days. Clearly, if we use our betting tone, then Jane has had a profit of 200 rupees. She agreed to buy at 600. She has contracted, she's obligated to buy at 600 something which is priced at 800. What exactly happens? How does settlement takes place? Number one, physical settlement, where Jane pays Michael 600 and gets the GGLE stock. This is known as physical delivery. The price increase is beneficial for Jane, F plus, because she is able to acquire the share from Michael at 600, whereas the market price of the share is higher, 800. The other method is known as cash settlement, wherein Michael pays 200 to Jane, and the difference is settled at expiration, obviously. It is important to understand the element of counterparty risk in forward contracts. If the party that is adversely affected, in our example Michael, by price movements, default on his commitment is a probable cause. The counterparty with the favorable position, that is Jane, faces default risk. This is true for both cash settled and physical deliveries for work contracts. Finally, we see that forwards or futures for that matter is a zero-sum game. One party gains and the other party loss. Jane gained 200 and Michael lost 200. Moving to pricing and valuation of forward contracts. The price of a forward contract is the fixed price or rate with which the underlying transaction will take place at the expiration of the contract. The forward price is agreed upon at initiation of the forward contract. Pricing of forward contract means determining this forward price, we need to calculate the 600 in the above example. The value of a forward contract is the amount that the counterparty would need to pay or would expect to receive to get out of its forward position. Let's work on a general example to introduce the concepts and mechanisms behind valuing forward contracts. The contract expiration date is denoted by T equal to T. The initiation date is denoted by T0, and at any point during the life it is denoted by small t equals to T. This is exactly how it happens. T0, T is the between time, and contract expiration T. The forward price is determined at contract initiation. Obviously, the 600 was determined at initiation, and it does not change over the term of the contract. The term F0T is used to refer the forward price for a forward contract that was initiated at T0 and expires at T capital T. I repeat, the term F bracket open 0T refers to the forward price 600 in our example for a contract initiated at T0 expiring at T capital T. The value of the forward contract changes over time. It shows who is in profit. Excuse me. The spot price S of the underlying asset may also change over the term of the contract. It may so happen that the GGLE stock changes from 500 to 450 to 650 to 700 to 600 to 800 over the period of the forward contract. In the following sections coming forward, we will illustrate how forward contracts are valued at initiation, at any point during the contract time, and at expiration. In order to avoid any confusion, we will assume a F plus position while valuing a forward. Once the value of F plus is determined, the value of the short is exactly the opposite. So if the value of Jane was 200, the value of Michael was minus 200. Please remember, it's always a zero-sum game. Valuing a forward contract at expiration, clearly a part of the learning objective statement. The long position on the forward contract is obligated. Jane has the obligation to buy the GGLE stock for an agreed upon price, that is 600, at the end of T30, 30 days. The price of the underlying asset at expiration of the forward equals to ST. Therefore, the value of the long position of the forward contract expiration equals to the difference between the spot price and the forward price. The current worth of the asset ST, which represents the price at which the underlying can be sold, and the price that the long position in the forward must pay to acquire the asset. If the value at expiration does not equal this amount, then arbitrage profits can be made. For example, if the forward price established at the contract initiation was 600 and the spot price at the contract expiration equals to 630, then the value of the forward contract is 630 minus 600, which equals to 30 at expiration. However, if the contract value at expiration was greater than 30, it means that someone in the market, some player in the market is ready to pay $30 to obtain an obligation to buy something worth $630 for $600, which wouldn't actually make sense. And if the contract value was less than $30, then it would mean someone is willing to accept less than $30 to give up an obligation to buy something worth $800 for $600, which again wouldn't make sense either. If the last 2 points have confused a bit, I would suggest please pause the video, go back, write down what I have said, create examples of your own, and then move ahead. Honestly speaking, I am the one here who is commanding, and you will not be able to understand the topic if you do not have that commanding tone. So I suggest take numbers, scratch it out at the back of your copy, and just move on with the concept. Forget the symbols, forget the numbers and everything, because at the end, our exam is not about symbols. You will be required to tick the answer. If you come up with XYZ or ST or F, doesn't matter. This slide shows the summary of the payoffs at expiration to the counterparties in a forward contract. I have given these formulas for the sake of completion and for students who love formulas, but I suggest it's not the way. For the long position, if ST is greater than F, it's a positive. If ST is less than F, it's a negative payoff, and vice versa. Once we've calculated for the long, it's obviously just the sign reverse for the short. Finally, you must also note that the forward contract initiated right at the instant of expiration would have forward price equals to the spot price. I mean to say that at T30, both the spot price and forward price would be $800 in our example. Essentially, such a transaction is known as a spot transaction. Now we'll value a forward contract at initiation. Let's see that a forward contract which has a term of 1 year. The price of the underlying asset is currently $100 and the risk-free rate is 8%. Let's determine the value of this forward contract at initiation at T0. Our situation 1 will be if the forward price is 110 and situation 2 will be when forward price is equal to 106. The forward price equals to 110 thing is highlighted here and not in the bullet points, if that's what you're wondering. So in scenario 1, when the forward price is 110, clearly arbitrage profits can be made through the cash and carry arbitrage by undertaking a few simple steps. We borrow $100 at 8%. We purchase the underlying asset at the current spot price of $110. And we sell the underlying asset forward by taking a short position on the forward contract at a forward price of 110. We've acquired the right to sell something at 110. We will need to pay 108 to the borrower. 100 we borrowed, 8% is the risk-free rate, tenure is 1 year. So 100 into 1.08 is what we need to give back. We have the asset now, and the scenario is our net cash flow is $2. Scenario 2, where our forward price is $106. Similarly, we arrive at a net cash flow of $2. Always remember, before anything, please spend time on this table and this table to clearly have a picture of what we are doing. And I would suggest again that take numbers of your own and get better at it and then move forward. Always valuing forward with the perspective of long is good. Get yourselves to think of the value of the long position as the current price of the underlying minus the present value of the obligation, which is the forward price. The long position has an obligation to pay the forward price and take the delivery of the underlying at the contract expiration. Similarly, the position at expiration and the value of the forward contract to the long position at contract is given on the slide. In scenario 1, the 210 and 108 scenario, the value of forward contract in initiation was calculated by this formula. The $2 was at the end of the 1 year. However, what is the value today? Contract at initiation is obviously the present value, and it comes to $1.85. And similarly, in the value of forward contract at initiation in scenario 2 is calculated using the above formula. Please spend a couple of minutes on this slide and understand what exactly are we trying to say. And again, take random examples and move ahead. The negative value to the long position in scenario 1 implies that a positive value of 1.85 accrues to the short position and vice versa. Let's exactly go to the short scenario 1. And we see the net cash flow of $2 accrues. We have the right to buy at 110, which is 108, and therefore we lose $2. Similarly, the price for short is positive 2 if it's minus 2 for us. I think for both the situations I said the long is earning $2, but there was a confusion from my end. So in scenario 1 the long loses $2, in scenario 2 the long wins $2. These non-zero values at contract initiation would entice traders to engage in arbitrage until the price of forward contract equals to the no arbitrage forward price. The forward price at contract initiation is the unique price that yields zero value to both F plus and F minus at inception. That is why we call it no arbitrage forward price, because value at initiation equals to 0. And we can express the forward price in terms of the spot price of the asset as the following formula. Clearly notice how the risk premium on the asset does not appear in determining the forward price. It just influences the spot price at best. And since we know the spot price, there is no need to determine the risk premium. The derivative market can simply let the spot market derive the risk premium. Do also note that although the forward price is fixed for a particular forward contract, a new contract calling for delivery of the same asset at the same point in time will have a different forward price depending on the current spot price. Now let's assume that underlying generates benefits and incurs storage cost. The forward price can then be calculated as spot price minus benefits plus cost whole into 1 plus RF to the power T. Y gamma, as I had alluded to earlier, refers to benefits and theta refers to cost. And these are in terms of present value for the equation 1. For equation 2, it would be that we are computing the net future cost and subtracting it from the future spot rate. So either you can use this formula or this formula on the exam. The key takeaways from the previous lessons include, because neither the long nor the short pays anything to the other at any. In fact, before this, I'd like to retrace my steps back. To understand the above formula, let's work with a forward contract on an asset that only delivers benefits and entails no cost. To acquire a position in the asset at time t, the investor could either buy the asset today and hold it until time t, or take a long position on a forward contract on the asset at a price of F as in the forward price. Either way, Either way, the investor would end up holding the asset at time t, but if he or she engages in the spot market transaction, benefits of the asset while the investor takes a long position on the forward would not reap the benefits associated with the spot asset through the term of the forward contract. The key takeaways from the lesson include the following points. Do have a look, understand it properly, go back if you've not understand something, and then proceed further. In the subsequent slides, we'll be valuing a forward contract during its life. We now use the logic to derive the expression for the value of the forward contract at any point in time. I'm sure by now we've digested the value of a forward contract to the long position equals to the asset's spot price minus the present value of the forward price. We'll use this logic ahead. The long position has an obligation to pay the forward price F and take delivery of the underlying asset at contract expiration. Unlike options, forwards is a right as well as an obligation. And therefore, the value of the obligation at any point in time during the term of the contract equals to the forward price divided by the risk-free rate, with the time n being the remaining maturity. At expiration, the long position will receive the underlying asset worth ST, and the value of this asset at any point in time during the contract term equals ST, S small t. Therefore, the value of the forward contract to the long position at any point in time during the term of the contract equals to the current value of the asset minus the present value of the obligation, which can be expressed by this formula. If the underlying asset entails benefits and costs, we adjust the above formula for such benefits and costs, and we get this formula to arrive at the value. In general, value equals to spot minus forward price. That's the entire tone of the formula. Please go through this summary slide that I have prepared for you with respect to the value of long and short position at initiation, at expiration, and at any time during the life of the contract. At initiation, no one pays or no one owes anything to anyone, so it's zero for both the parties. If it's not zero, then arbitrage would exist, and arbitragers would conduct arbitrage in order to remove the price inefficiency. At expiration, value for long is spot price at expiration minus forward price, and during the life of the contract, it's spot price at that point of time minus the initial forward price discounted at the required rate of return for the remaining maturity. Once we calculate the position for long, we can clearly put a minus sign for the short position, since, as I repeat, it's a zero-sum game. We'll now look at a few examples, and I suggest you take out your calculators, and we will be calculating the forward price during its life, the normal forward price at expiration, and everything. Amanda holds an asset worth $250 which she plans to sell in 6 months. To eliminate the price risk, she decides to take the short position in a forward contract on the asset. So she's actually F minus. Given an annual risk-free rate of 5%, calculate the no arbitrage forward price. I would suggest that you first do the question on your own, pause the video, do the question on your own, and then look at the solution. We all know that forward price is the future value of the current spot price. So therefore, the current spot price is 250, time is 6 months, that is 0.5 or 1 by 2, and risk-free rate is 5%. Therefore, the forward price will be 250 into 1.05 to the power 1 by 2, which is 256.17. Next example. Calculate the value of a forward contract during its life. From the position of a long Forward, it is spot price at that time minus the initial forward price discounted at the required risk-free rate for the remaining term of the contract. The current spot price is 262 and the original forward price was 256.17. Time remaining maturity is 4 months, so it will be 262 minus 256.17 divided by 1.05 to the power 4 by 12. Our final example, we calculate the value of forward contract at expiration, and this is simple example where the value at expiration is calculated as the spot price at expiration minus the initial forward price. That is for the long, and for the short is just the reverse sign. So value at expiration is $247. We calculated the initial forward price as 256.17. Therefore, the value to the long is 247 minus 256.17, which equals to minus $9.17. Please stop, redo all these examples, and then move ahead. We'll now go to forward rate agreements, which are forward rate on interest rates. A forward rate agreement or an FRA is a forward contract when the underlying is an interest rate. The most common interest rate used is LIBOR. It might help you if you think that the long position in the FRA as the party that has committed to take a hypothetical loan and the short as the party who has committed to give out the hypothetical loan. So F minus, F plus and F minus. This loan will take place at something known as the FRA rate. However, F plus and F minus are not explicitly used notation, but for the purpose of our strengths, we should play on our strengths and understand he has committed to take a loan, he is committed to go long on a loan, and therefore he is F plus, and the other party is committed to go short on a loan, therefore he is somewhat similar to a F minus. However, no actual loan is made at the expiration date, and therefore there is no need to consider the creditworthiness of the parties in determining the FRA rate. The play here is simply on interest rate movements. Recall that LIBOR represents the rate of return on the euro-dollar time deposit, a loan in USD from a London bank to another bank. The payoffs of FRA are determined by market interest rate at the expiration. If LIBOR at FRA expiration is greater than FRA rate, the long benefits. Assume Mr. X contracts to take a loan at LIBOR, say 6%. And at expiration, the rate goes to 8%. But he'll get the loan at 6% only because he had contracted to buy a hypothetical loan or take a hypothetical loan 6%. So indirectly, it's a betting tone which I told. मैंने agree किया that मैं 6% पे लोन लूंगा. बाद में मार्केट रेट 8% हो गया, लेकिन मेरे को तो फिर भी 6% पे मिलेगा ना, तो 2% तो बेट हो गया मेरा, मैंने बेट किया था, उसके कारण ये 2% मेरा फायदा हो गया. If the LIBOR at FRA expiration is greater than the FRA rate, the long benefits. Effectively, the long has access to a loan at a lower rate than the market rates. 8% के बदले 6% के rate पे access है loan को, while the short is obligated to give out a loan at a lower, that is 6% rate than the market interest rates. The whole point of getting into an FRA is to hedge against interest rate risk. A borrower who likes to lock in the borrowing rate would take a long position, as I said, Mr. X, on an FRA, while a lender, while the lender would take a short position on an FRA. The interesting thing about FRA is that the underlying is not an asset, it's an interest rate. However, synthetic FRAs can be created by taking opposite positions on two euro-dollar time deposits with different terms to maturity. This ends our reading. This ends our lecture on forward contracts on interest rates. In the future contracts, we'll learn how to price of FRA and we'll do a few practice questions with respect to the same. Thank you.